Hi, my name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. Welcome to the January 2014 Market Overview. Happy New Year. All I can say about 2013 in the stock market is wow. We had the best year since 1997. Every single index was either at an all-time high or was at a multi-year high. It was a great year. And we can continue to be cheerful because what history tells us is when we have a year like the one we did, we probably have a pretty good year in the following year as well. So the overall context is quite positive. That said, though, there are some reasons to be concerned. The first is that much of the gains from last year came from what's called multiple expansion. The prices of stocks increased by a lot more than their earnings. And they're now at fairly high levels on a historical basis. So that's a reason for concern not only for maintaining levels, but also for going up. If values are already pretty fully priced, it makes it harder for them to go up. The other thing is that some of the tailwinds that have been driving earnings have started to go away. So while there are reasons to be concerned, the overall context remains positive, and that's a good thing. Supporting the stock market expansion has been a very strong performance by the real economy. Employment has continued to grow. Wage growth has started to accelerate. We've seen unemployment come down much faster than people thought. All of these are very positive signs and, of course, led the Fed to start to taper its stimulus program, which is actually an endorsement of the economic improvement. One of the big savers of the economy in 2013 was the housing market. Now we're starting to see that strong recovery slow, which is not a reason for concern. It's actually a very good thing because the housing market is normalizing. We're moving into a normal economy. We had the strong recovery from the pit. Now we're moving into normality. That's a good thing. The other things that have been very positive and will continue to be very positive are manufacturing. We're adding manufacturing jobs in the U.S. in a way we haven't done in decades. And the energy boom in the U.S., which has cut costs for companies, cut gasoline costs for consumers, improved the trade balance, and essentially benefited everything across the board. All of these factors are likely to continue. If you look at government actually was a drag on economic growth and in other ways in 2013. We had the fiscal cliff at the start of the year. We had the tax increase at the start of the year. We had the sequester spending cuts early in the year. Every single one of those things hit economic growth. This year, we have a 2-year federal budget deal. We have no tax increase. We have, in fact, no spending cuts. All of those detractors from growth have gone away. At the state and local government level, we now have a situation where instead of cutting spending, they're starting to increase spending because they have the tax receipts because the economy is improving. This is a virtuous cycle. And we will actually see, I believe, government add to economic growth for the first time in years this year. And that will be another positive factor. If you look at the international scene as well, you see equivalent improvements. Europe is no longer digging a deeper hole. They've actually started a slower recovery. China has weathered its political transition. It continues to grow. Both of those are markets for U.S. goods. Both of those can help the U.S. recover. And in fact, that's actually what we see happening. As we start 2014, I don't think there's any doubt that we are in a much better position than we were at the start of 2013. Our economy is better. The stock markets are much better. The world as a whole is much better. We still have things to worry about, certainly, but I think I can say confidently that we are probably as well positioned at the start of this year as we have been at least for the past several. Thanks for listening. I'll talk to you next month.